right, there we go.
Are we on?
We're on, right here. All right. For anyone that's on, like Chris, Kat, can you guys hear us okay? I know there's still a lot of background noise, but I just want to make sure the sound's where you need it.
Loud and clear.
Okay, thank you. All right, are we ready? Hi, everyone. I'm Nicole. It's nice to see everybody. Thanks for joining.
Yes, and so we wanted to welcome Nicole here, and she's from Credit Repair, a company called bSquared Credit. And Keith and I have both used her for years and years and years. Perfect example, I've gotten people's credit score from the low 500s into almost 700 in maybe 6-7 months, where they can actually afford to buy a house. She's very responsible. She's going to talk today about the methods and maybe certain things on how to improve credit. And
yeah, over the years, you run into people that say that they can fix credit, and we often see that it doesn't work. With Nicole, we've never had that issue. She's all my clients have over the years have said that she does great with it. She, she'll go through her whole system on how she does stuff, but definitely trustworthy, that somebody legitimate that you can count on to help out with your clients.
And at the beginning, what we do is we provide her with a credit report, and she sees the scores up front, obviously with the client's permission. And then we let her know, well, this is the program that you need to fit into. This is the FICO score that we need for that program. And then she goes back to the client and she tells them how long it's going to take, how much money it's going to be, and what they need to do right up front. So there's no surprises. So that's
Right.
very good. And she does what she says she's going to do.
That's right.
Thanks, you
So,
guys.
guys, Nicole Soares.
All right, thank you guys again so much for having me. So I prefer to stand. I feel like it's kind of weird. Like, I don't know that they need to really see me. I think I'm gonna turn my camera off. I don't know, it doesn't matter. Anyways, all right, so I just want to start with just a little introduction. So I've owned bSquared Credit since 2011. Lisa and I were just talking. I had a partner, Brent. So you guys, if you've worked with us at all, you might recognize that name. I now took over ownership, and he's still very involved, and he oversees our processing now out of Coeur d'Alene, Idaho. So some things that I want to go over and kind of focus on is really the types of clients that I can help. I want to give you guys the tools so that when a client says to you, my credit score is X, you can go, okay, that's interesting. Tell me about it. And I want to give you a couple different questions you can actually ask your client to really understand what they're really trying to tell you. Because when they say their credit score is 680, there's probably 5 questions I would ask to really understand, where they got that data, what score are they talking about, and what that really means. So I want to give you guys some tools to understand some basics about credit. And then also just kind of talk about where we can work together. And then also some areas where we, really aren't a good fit for us. And it's not that I don't want you to refer them to us. I just want you to know that there'll be times that I send your clients out to one of my partners to help with a specific problem that may look like a credit problem, but it's really something deeper. And I'll explain some of those scenarios too. So feel free to make this interactive. If you guys have questions, I think I'll hopefully answer a lot of them in the first probably 5 or 6 slides. And then after that, I think it'll be a great opportunity to kind of pause and see what's on your mind and things like that. So anyways, again, Nicole Soares, bSquared Credit is our brand name. That's the company name. You're going to see another name called Credit by Nicole, and I'll explain a little bit about some evolution and work that we're doing for launching literally this month and then into 2022, which will be news to Keith and Lisa as well. So one thing I like to start with whenever I'm doing a presentation for partners is the elephant in the room, because for some of you guys, you've probably been burned by credit repair in the past. Any nod, shake? Have you guys worked with credit repair companies? Have you found that it impacted your client relationship, client satisfaction? Yeah, it definitely can. So I want to just tell you a little bit about how we're different, and then hopefully I'll have the opportunity to show you guys with either your own credit report or family member or client, so that you can really see the end-to-end process and how we do things differently. So one of the very first things is when we're talking about credit, everyone focuses on credit repair, and credit repair can mean a lot of things to different people, but ultimately what it is we're raising somebody's credit score, right? That's the goal. But credit repair as an industry really is disputing negative items on the credit report, right? Whether we're using online tools or paper process, it's irrelevant. It's focusing on cleaning up the credit report. And that's great. That's what Lexington Law and a lot of companies do. But the reason clients are so dissatisfied, and this is one of the things I really want you guys to understand, and I'll give you some visuals for this, 35% of your credit score is based on, do you pay your bills on time? So what's the other 65%? The other 65% is, how do you manage your good credit? So if I only focused on the 35%, would I really be providing everything that I could be providing to a client? And that's really what our differentiator is. So I worked for FICO. I worked for FICO for 5 years. FICO is the credit scoring brand that a lot of us know. Movement Mortgage, that's all they use are FICO scores to qualify a loan. But my background is predictive analytics. And so for years, 30 years to be exact, I started when I was 16 at Bank of America as a night collector. And so I've been in this industry and understood how the analytics behind these scores and what a 700 score means. And so I can look at a credit report and I can say, this is where they're missing out on points for their good credit, and I can coach and educate them. And then these are the areas where, removing negative items is going to be impactful for this client. So again, one of the biggest differentiators on kind of talking about the industry problem is the industry problem doesn't have those expertise, and therefore they focus on the 35%. They don't focus on the 65%. Any questions about that? Does that make sense to you guys? Okay, great. So let's just jump in. My objective in working with both the loan officers, the realtors, is really to be able to help you guys be more successful. Obviously, I win when you win, right? It's kind of a, I'll scratch your back, you scratch mine kind of relationship. So when you send us a credit challenge client, a lot of times it works really well when it comes through the loan team. It doesn't mean you can't work direct with me. I'm happy to take your referrals direct, especially if you have a client that maybe just went through a life event. They're not really ready to buy yet. That's not their specific goal. Maybe it's, how do I recover from a divorce, or how do I recover from a medical issue or something that had a big financial setback? Now I'm financially stable. I have a little bit of money, but I don't really know what to do. What bills do I pay? Which ones do I just leave alone? Give me a prioritization plan, right? So those types of clients are great just to come direct to me with. However, when you have a client that says, I'd love to buy a house, I just have really crappy credit, I can't qualify. Like, how often do you guys hear that from your clients? Like, I'd love to buy, but I just can't, right? Credit sucks, sorry, don't waste your time on me. Those are the clients that are important to either go through the loan team to pull the credit and do a referral to me, or come to me, it's irrelevant. But ultimately, the beauty of working through the loan team is they're going to tell us what middle credit score they need to qualify for the specific loan program, FHA, first time home buyer, conventional, whatever that program is. And they're also going to tell us if they're a really good loan officer, which most of Movement Mortgage nationally I work with are. They're going to tell us the underwriting criteria, right? So we have a score cutoff. I think of it in layers. Layer 1, score cutoff, you fail that, then no pass go, come to me, right? Let's say you do have a score. However, for the first time home buyer program, you can't have any collections with balances, right? Zero balances of defaulted accounts. The underwriting layer I see as a phase 2, and sometimes that's the deal breaker, and that still can come to me because we can help negotiate the debts and, by the way, strengthen the credit score still to help them improve their qualification, even if they're at their minimum, right? Because most lending decisions are risk-based pricing, and all that means is the higher the score, the lower the rate, right? The higher the score, the lower the risk, the less you pay. So because of that, even if they meet the minimum criteria, let's say it's 580, but we have an underwriting phase 2 criteria, ultimately I'm going to solve for that, but at the same time, I'm focused on raising the credit scores to strengthen their overall process and pricing. Okay, so ultimately it's a win-win. When you come to us, I have 3 major focuses in working with your clients: educate, evaluate, and empower. What does that mean? I feel so strongly that in anything that we do in life, to really be able to influence change and focus on change, we've got to understand some basics. And that's what I'm here to teach you, some basics on credit. I want you guys to understand credit enough to be able to speak intelligently, not expecting you to be experts, but to just have some really good conversations with your customers about credit. And focus on like all these myths that you can debunk, because there's so much misinformation out there. But my commitment to your clients and to you is to help educate. And those are some areas that we're really focused on growing. And I'll explain that through some of our do-it-yourself stuff that we're working on. And evaluate. Evaluate is about you or your client or us working with your client. What is your baseline? Let's evaluate your credit. Let's evaluate your goals. And let's figure out where are we today? Because if I can't figure out a baseline for you, how am I supposed to get you from X to a 680? Right? And so I need to know where we are today and figure out what that credit report looks like. If you call me and say, Nicole, I have a client that needs 50 points, I can't give you advice without understanding what their credit report looks like, right? Because it's unique for every client. So I got to understand their baseline. We do that through evaluating their current credit situation. And empowerment is always through influencing change and implementing the recommendations. The recommendations are rarely, Nicole's going to run off and fix your credit. The recommendations are, here's your task list of what you need to work on, while I'm focused on the 35%, right? You're going to get a list of, you need to build more credit, pay things down, do some different things, and I'm going to help you with the 35%. Cool. So that's how we really run all of our services. So I mentioned this a little bit, and this is what I'm most passionate and excited about. So for 11 years, I have done one-on-one client interaction, right? You send me a client, I work with your client, I pass them back, you do their loan. One-on-one, I only have so many hours in a day. Sometimes it's a lot of work. What I'm really focused on now is not just offering full services to every client. Some of your clients, they want to do it themselves. They want to just learn and go, how do I get 50 points in 30 days? I just tell me the 5 steps. Well, guess what? We built a guide. We sell it for $27. It's 5 steps. It's 50 points in 30 days using our 5 steps. So now we're doing do-it-yourself, both free guides. Think of a ladder approach. We're offering do-it-yourself education support. You come to me when you want to add more. I'm not going to require you to go all full services, which I have done for 11 years. Now we're really trying to bring on the ability for me to build something one time and deploy it 1,000 times, because there's enough general information that applies to 90% of us that will be enough for some customers. And then they can bring in custom solutions and full solutions and stuff as they need them. So you'll see a lot more branding around Credit by Nicole, and all that is it's a differentiation. I'm totally saying it wrong. Please somebody say it for me. Differentiation. Oh my gosh. It's still under bSquared. It's just do it yourself. I think of it as just credit education is really the Credit by Nicole brand that we're deploying right now, that we're having a lot of fun with. It's a lot of videos, a lot of screen capture recordings and things like that. So it's been a lot of fun creating that. And then instead of full service, I really think it's a done with you service, because as I've stated, and I'm going to repeat myself 100 times, is that I can't do everything for you, but it's a done with you. I'm going to give you the plan. We're going to customize it. I'm going to provide full services for the aspect of it. And then I'm going to support you and coach you through the engagement to hold you accountable and kind of handhold you through the actions that I'm suggesting that you take. And so you'll see those are our traditional credit repair. We call it credit dispute process. Negotiation, settlement work, student loan modifications is a big part of our practice. Customized coaching programs, checkups and memberships. So we've had, Lisa and I were just looking through her client list of all the years her and I have been working together. Her one client, she was just saying they just closed on a loan in April. Right. Yeah, and I think they were introduced a few years prior to that, but maybe didn't act or wanted to do some of it themselves. And then January, they came back for a checkup. So we charged $35. I relook at their report, give them an itemized updated list of what they can start working on, so that by April they had the scores where they wanted them, and Lisa was able to do their loan. So that's what we refer to as checkup and memberships. Okay, any questions before I jump into a little bit of deeper credit education? Okay. Have we worked any files together? Have any of you guys ever referred, or maybe referred to Keith or Lisa that came to me and then you guys were able to kind of see the chain in any way? No? Okay. Hopefully we'll get to do that. So tell me if this is a common question that you guys get. Why, when I go to Credit Karma, does it say my score is 680? But when Keith pulls my credit report, he tells me it's a 580 or a 600. Does that ever happen?
I don't always say that, but it does.
Okay, I want to explain why this is. Now, this is all detailed out in a free guide called Credit Clarity. That's our most recent guide we just republished. We used to call it Credit Score 101. How boring is that? We've rewritten it. It's called Credit Clarity. We're literally launching it this week. So I'll give you guys the link. Love for you guys to read it, understand it, but this is really the what that guide does is answers this exact question. So before I give you the answer, let's at least ask Lisa and Keith, why does the credit scores differ? We're gonna put them on the spot.
Why is it different?
Yeah, why do the credit scores differ between Credit Karma and your loan?
Well, I mean, my general working
Application.
knowledge, I would guess is that everyone has different criteria on how they rate credit. And for whatever reason, whatever Credit Karma is using is not maybe as in-depth as using the 3 bureaus. So I would assume that, for the Credit Karma, most people just want a light review. Hey, they're okay to work with. Great, I'm gonna do something with them based on that. On the mortgage side, we're lending a lot of money. So we're gonna be a little more restrictive on our guidelines and what we're looking for and how well somebody pays things. So
Okay.
I'm assuming that's different. I could be wrong.
So let me answer it. And I'm not saying it's totally wrong, but I'm going to use different terminology.
That'd be great.
So the credit score differs by bureau, by brand, and by day. So day's an easy one, right? Remember the Credit Karma commercial where it's like, don't tattoo your credit score on your arm? Do you guys remember that? It's literally a living and breathing score. And why is that? Because every day the credit bureaus are posting new data to our credit reports. Every time we have new data, it then influences our credit score, and our credit score is different. Okay, so day's easy, right? It's constantly changing. Let's go to bureau. Bureau is what? We have 3 major bureaus. And when we're buying a car or getting a credit card, they might just pull one credit bureau and make a decision. However, in a mortgage situation, it's a big loan. And so they pull all 3 credit scores, or all 3 credit bureaus and credit scores. So in that situation, they drop the high score and the low score, and they price it on the middle credit score. Okay, that's how mortgage has done it for years. Why the bureau scores differ, I'd like you guys to understand, and we'll go into that, okay? You can see discrepancies of over 100 points between the high and low. We see it every day, all the time, okay? So I want you to understand why that is, and then I want you to understand brand, and this is kind of what Keith was alluding to. Credit, let me just see what my next slide is. I'm gonna take a little peek here. Oh yeah, I'm gonna go into it here. Okay, so when I teach, I like to talk about catch up. I don't know why years ago this is just stuck in my head. So you know when you go to the ketchup aisle, the condiment aisle, and you see 50 different types of ketchup, right? Heinz actually owns the market in ketchup. I just happened to research it. They own it nationally, funny enough. So if I wanted like top of the line ketchup for my house, it's gonna probably be in my fridge for 2 years. I might get the like spicy organic Heinz, right? But I'm happening to throw my son a birthday party. We're gonna be out in the sun all day. And I just went to Vaughn's and it just happened to be on sale for $1.99. And I got the Vaughn's, branded ketchup. They're both still ketchup, right? They both look very similar, but they're not the same. The generic one probably has corn syrup in it, probably isn't using organic tomatoes, right? Probably has a bunch of fillers, maybe even food coloring. Maybe it's like the ugly tomatoes that nobody wants on the shelf, right? So ultimately, they're both ketchup. There's a huge price difference. They have different ingredients, and they have different amounts of ingredients, okay? So now, let's talk about credit score. FICO is what lenders use 90% of the time when you apply for credit. Any loan, not just mortgage, any loan, we're using FICO. I worked for FICO here in San Diego for 5 years. I literally learned anything and everything you could know about fraud and credit analytics through working through FICO. FICO is the most trusted. It's been around the longest. They used to say we have a monopoly, because for years we didn't have competition in credit scoring, and really not even in fraud scoring and some of the other analytics. So what do? They get all of this big historical data, goods and bads and client behavior, and they say, this analytical solution, this model is here to predict risk, to predict how likely you are to repay a loan, right? The higher the score, the lower the risk. So FICO owns the market and most decisions still does. However, a handful of years ago, the 3 credit bureaus got together and they said, I don't really like giving FICO all this money. Like, let's create a competitive score. And they created Vantage Score. It was one of the first times the bureaus worked together in order to create something like this. And the score is predictive of risk. However, it is often much higher than the FICO credit score. Do you think that's for marketing purposes? Maybe. Could be they just don't have enough data, enough historical information. They're just not as good as predicting risk, right? Regardless, they're different brands of credit score. Okay, just to go back, right? They're different brands of credit score, but they use the exact same bureau data. So when they deploy their model on the TransUnion report, it's the same brand of credit. It's just a different data set that they're overlaying their model on. Okay, so the data is the same. They don't, like, Credit Karma has the exact same data that the lenders, loan officers have. Data is the same. Okay, TransUnion, Equifax, Experian have their own data sets exactly the same. That's one of the biggest misinformation out there. Okay, the brand, however, is different of the model that's being applied to that data to predict risk. One more brand is Credit Expert. I'm not going to go too deep into this, but are you familiar when you work with these guys and they say, hey, we're going to run our analyzer, and the analyzer is going to tell our mutual client what to do to raise their credit score so we can get this loan done. You guys heard of the analyzers that these guys use? It's kind of new, last couple of years, analyzers came available. The analyzer uses Credit Expert to predict risk. So I'm just going to leave it at that because it's pretty confusing. When I meet with lenders and we really talk about the analyzers, this is really important for them to understand. And Lisa and Keith, I'd love to talk to you more about it. It's in the small print down below. It just means the analyzers are great in some situations, not so great in others. And I'm going to give you a pie chart to explain that more. Okay, so do you guys feel like you have a pretty good understanding of the 3 reasons the credit scores differ?
Yes, we have a question.
Okay,
online.
all right, please.
But you want to first go ahead.
For the just of my understanding, FICO is what we really should pay attention to.
Mm-hmm.
And we want to really know what's the actual credit score, right?
Totally. Yeah. And I would say I like the Vantage credit score. I actually recommend it often, but I don't recommend it if somebody is going to get a loan and we need to know exactly what their FICO score is in 3 months or 6 months.
So that's the FICO score that we usually see in online banking.
Yeah, exactly. So so this next slide is going to explain the answer to that, because the answer is yes. The answer is yes, but no. Okay, so let me explain, because real quick, one more question and then I'll get to it.
The question was, sometimes this is from Chris, and Chris is asking, sometimes I seeing a FICO 7 and a FICO 9. What is the difference between those? Okay, so Chris, you're on to my next slide. So thank you for helping me transition here. Okay, so then just to add even more confusion, okay, you guys understand brands now. There's multiple models within the brands. So let's talk about FICO, because this is all I really care about right now. From this point forward, we're going to talk about FICO. If you go to get a car loan, they're going to pull a FICO auto credit score. Well, why is that? Because if you've defaulted on your auto, do you think your auto score is going to be lower than maybe your credit card score? Absolutely. So FICO, because they had been doing analytics for so long, they were able to start slicing the data differently and saying, you know what, I can make a more predictive model and credit score by application type. Okay, so now we have a FICO auto, a FICO mortgage, a FICO credit card, a FICO general. Okay, they're not actually called that. To Chris's point, you might see FICO 4.0, FICO 5.0, right? So
it's represented in numbers, not necessarily in name. However, there are industry standards that, FICO 5, I think, is the mortgage model, or 4. Sorry, I should know that off the top of my head. But anyways, there are industry standards that auto uses this model, and because that's what FICO's recommendation is, that to get the most predictive, you use this model for these application types. Okay, so let's look at Robert. Robert actually was a client of mine. He was an engineer. And Robert really wanted to understand this because he was so pissed off that he went to go get an auto loan and his Credit Karma score of, let's say, 740 didn't match the auto FICO model, which came back, let's say, at a 680. And Robert's like, this doesn't make any sense. You need to fix it. And I was like, well, we don't really need to fix it, right? I just need you to understand what's causing the difference. So Robert went to myfico.com, which is an ability to do a soft pull your own credit. I'll explain that in a minute. But he went and pulled his own credit, and he got all 3 credit reports, and he got all of the FICO models. He got auto, bank card, mortgage in general, okay, all in one report. Cost him $40. My FICO is not cheap. And then we went to Identity IQ, and we got the Vantage score. And then we compared these all. And what we saw is that Robert's scores differed by 77 points across the brands and across the bureaus. Okay. And you can see down at the bottom, right, for auto between the bureaus, it was 27 points. But if you look here, auto TransUnion for FICO was 651, but his highest score on here was like 715. Yeah. So my point being is, if you pull them all, exact same day, exact same 3 credit bureaus, just different analytic models, you can see the discrepancies in one client situation. Okay. All right. So let's look at why. So kind of like the Heinz, right? We just have different amounts of ingredients and different ingredients that create the ketchup. In credit scores, this is some of the biggest differences in the pie chart here. So here is 35%. I was saying this quote earlier. I was using FICO when I was giving you the percent. 35% of the credit score is based on, do you pay your bills on time? Everything else adds up to 65%, and it has nothing to do with, do you pay your bills on time? It's how you manage your credit. Okay. So let's take a look at the Vantage score. Vantage says, you know what? It's only 32% of your credit score if you do or don't pay your bills on time, right? So right away, we can tell one of the reasons why the scores are going to look different, because they're weighting that particular risk or that variable differently between the 2 credit scores. Okay. So I will take a minute to go into this because I think it's important for you to understand the FICO pie chart. Okay. So payment history of the 35% can be managed through credit repair sometimes. Not everyone's a good fit for credit repair just because they have dings on their credit, okay? Sometimes it's settlement work. Sometimes it's pay for deletion, where we do a settlement and negotiate with the collection agency the removal of the collection as part of the settlement agreement.
I have a question about that, if it's okay.
Sure.
Often people have something that they want to get deleted, and the companies might say, oh, we can't delete it, or things like that. Do you have a different reaction when you call versus when they call?
Yeah. So pay for deletions have become more common. Collection agencies have changed their policies, I'd say, a lot through COVID. The last 2 years, we've leaned a little bit more towards that than we have through credit repair for some situations. I have a database of the collection agencies that I've been compiling for years, and I have 2 other credit repair companies and attorney's office that we share a database, and we list which ones we know do and which ones we know don't. And that's our kind of secret sauce, right? Because I know, when I get a client, what I'm going to recommend based on where they are in that spreadsheet. But yes, I can poke holes. If I can go back and go, you were mailing this to the wrong address, the client hasn't been at this address, or I can poke holes in, there was return mail. Like, I always validate the debt when I do settlement work, and I try my hardest to poke holes in it if I know their policy is not to remove it. And then I demand an override in the policy based on what my findings are. So that's just sometimes.
Yeah, no,
Yeah.
that's awesome, because everyone will ask things like that, or they
Mhm.
said they tried to call. And so what I'm trying to say is that, Nicole probably has better tools and resources than we do. So, we might do an upfront suggestion, but she'll have a much better suggestion.
Yeah, it really just comes down to techniques and,
Right.
and yeah. Okay, so 35%, I'll be honest, sometimes we gotta let it age, right? I mean, the older something becomes, the less of an impact it has on your credit score. So there are times that credit repair and settlement work just isn't gonna work. And so what do? Well, we're like, okay, well, we still need 20-point improvement. I know that I can't influence this part of the credit model. Thank God I had 65% of other stuff I can look at, right? Because an expert in credit scoring, I can do that, where other credit repair companies are like, sorry, did our best, right? And then they get unhappy clients and bad reviews. After 11 years, I actually just got my first 1-star review like 2 weeks ago that broke my heart, and I can't get the guy to remove it. But in general, we've had literally 5-star reviews for 11 years. That's really hard to do in our industry. But it is important that, we're upfront. We're like, you know what? I'm not going to put you in credit repair for this. I just don't feel this is going to come off. I think we need to focus on you doing X, Y, and Z, and you're going to get to your goal. Maybe not in 2 months the way we would have if we did credit repair. It's going to take 4 or 5 months, and this is why. But I'd much rather be honest and give them the plan and be realistic up front. I don't want to put somebody in a service that's not going to get them, to their end goal. So you'll see that a lot with us. Yeah.
Right.
I find it interesting how different the breakdowns are.
Mhm.
Payment history, that's the same, but other than that, like utilization, look how much
Yeah.
Vantage puts on that versus
Yep.
FICO as amounts owed.
Yeah. So let's talk about what that is. So amount owed is specific to revolving credit cards, store cards, HELOCs, right? So HELOCs are not my favorite product sometimes, especially if they're going to turn around and max it out right away. We'd rather have a fixed mortgage for credit scoring purposes. But
HELOCs are a
anything.
home equity line of credit, by the way.
Oh yeah,
In case
sorry.
you don't know what that is. It's a second on your
Thank
house,
you,
often like a
Keith.
giant credit card on the back of your house.
Yeah. Yep. Thank you. But it's how much of your open to buy are you using? So if you have one credit card with a $500 credit limit and you're maxing it out, let's just call it 475, right? So let's just call it 95% utilized. It is the same impact to that person's credit score than somebody who has $50,000 of credit cards and $49,500 of balances. Okay. It doesn't matter the dollar amount, it's percent utilization. So guess what? If you don't have any open credit cards, you're missing out on 30% of your score. It's literally that impactful.
Yeah, so sometimes no credit is worse than bad credit,
Yeah.
right?
Yeah. Yeah.
So you want to have credit cards open, but not like maxing them out.
Exactly.
Kind of like keep them
Yep.
and then pay like regular payments.
Mm-hmm.
What if you pay it off? Like, what if you like get one and you put like $500 on it and then you pay it the $500 off the next month?
Yeah. So the difference is, and if I'm coaching young adults or new people to this country that have very little credit history, then I want them to carry some small balances below 19% revolving utilization. However, for those of us that have mature credit that have proven we can be responsible over time, over 6 months, a year, then I say pay it off in full because it's partly a financial and a credit recommendation that I provide you. I don't think anyone should be paying interest, but ultimately you are lower risk if you pay up your bills in full every month before the due date, obviously on time. Yeah.
What's the percentage should be, like what percentage shouldn't people pass over their credit card balances?
Portion of balance.
Yeah. So under 19% is 19. 19%. So if you're at 50%, you're not missing out on all of your 30% of this part of the pie chart. You're just missing out on some of it, right? So if Keith's analyzer, and Lisa's analyzer says, hey, all you have to do is pay down a card to 50%, great. Then that is going to get you, let's say, the 20 points that they need for that particular loan. So the analyzer is very predictive on revolving utilization rate because Credit Expert, going back a couple slides for that other brand I mentioned, is very aligned with FICO in the revolving part of the calculation. So it's good at predicting how much somebody needs to pay down. And I learned something recently that I didn't know. Don't quote me on this exact number, but the analyzer assumes you have $2,500 or something like that, and that it only gives you recommendations up to that dollar amount.
So sometimes yes, sometimes no. Now with Credit Expert, which both Lisa and I have access to, it's our quick fix for some things, and then we call Nicole to see if it's right or not. But it doesn't necessarily ask you how much money you have. It just says, do you want to get to 660, 680, 700, 720, 740? You hit the whatever number you're trying to get to, and it says, okay, you need this much money to do it.
Oh, okay, so you can actually put the target score now in your analyzer.
Yes.
Okay,
Correct.
great, awesome.
So I'm gonna go kind of extreme. So let's say you have 10 credit cards open
Mhm.
and they're all under 19% utilization and you're paying them all minimum payment every month on time. Are you gonna get a good amount?
Well, that's when the rest of the pie chart comes in. Okay, so I'm gonna, so let's keep going, and then if I don't answer your question, bring me back there, okay? Length of credit history is obviously how mature is your credit profile, okay? So, you know, if it's a year old, it's very, very young. There's absolutely no way you can get to an 850 credit score if you've got a 1-year-old profile, right? So length of credit history matters, and so that's why we don't want to be opening and closing accounts. We want to make sure we have that one account that or two accounts that we keep for a long time, right? And that obviously has to be a revolving account because fixed loans, like installment loans, have a 5-year date or whatever the date is. Mortgages are different. But generally that really matters. And also the next to 10% is mix of account types. It says types of credit card and the credit and then cards used. So think of that one as mix of account types. So if you have only credit cards, you're missing out on 10% of your score. We want to see installment loans. We want to see mortgages. We want to see that you can have a mixed portfolio of active open accounts, not the auto loan you had 5 years ago or last year. It's open active accounts showing that you can be responsible with several types. Okay.
And I will say, just to back that up, when somebody doesn't have a mortgage and then they add that mortgage mix into things, their credit score pops. So.
And not initially, and that's because new credit is 10%.
Right.
So when you have inquiries and you have new accounts, especially mortgages and installment loans, it really does take 9 to 12 months. And think of it this way, all of a sudden you get this big disbursement of cash, 100,000, you know, an auto, 50,000, 30,000, whatever. You get this big disbursement of cash up front. The credit score freaks out. It's like, I don't know, can they handle it? Right? All of a sudden it's $500 a month. They didn't have this debt before. We don't know if they can handle it. So then they take your credit score and it's kind of like proven, you prove it to us, prove it that you can be responsible for this debt. Then I'll give you those points back. And then I'll actually give you more points because now you have mix of account types. Okay. So it doesn't work that way so much on credit cards unless you go and max the new credit card out. You can open a credit card and you won't have too much of an impact to the credit score. And sometimes it actually pops your credit score. But if you go out and highly utilize it, then obviously, you know, now it causes a problem. But if you just have it open and you're using it, you're paying it off, that's totally fine. Credit cards helps you increase your credit score quickly. However, installment loans and mortgages will bring them down temporarily, and then you'll earn those back and some. Okay, so back to your question. So I often get clients that'll come to me and say, okay, Nicole, I've had this huge credit card debt problem, $50,000. I've got $25,000 right now to put towards it. Give me a prioritization plan. I charge a nominal fee for that. It's coaching services, and I create a prioritization plan. And here's my free advice. We go for any accounts that have ever been delinquent in the last 24 months get paid down first. Oh no, take that back. Any account that's closed with a balance first. Okay. Second is any account that's been late in the last 24 months. Third is youngest card. Fourth is store card, and then everything else.
Okay, say the one.
Can we
after
get that
24
later?
months.
No, I'm going to give it to you for free once. That's all you're getting. I charge for this, Keith.
Okay,
All right. So who
I know they're gonna ask
who has notes? Take me through what I said so far.
Any account
That's been closed.
Closed first.
with balance.
Yeah, with balance
Any account late.
in
in the
24
last
months.
24 months.
Youngest,
And then
Youngest account open, newest open date.
and then
Store card is higher risk than credit card. And the data that tells me that is people forget they put a balance on a store card and then it goes delinquent. So you have a higher probability of going delinquent on a store card than a regular credit card, and therefore it's deemed a higher risk. Therefore, that's number 4, I think, on my list.
Store card, what do you mean? Like a department store?
Macy's, yeah,
And
TJ Maxx, whatever. Anything that's associated with a retail store, you can't use that card everywhere. It's associated and only used at a retail store. And then the last one is everything else. It doesn't matter if it's a home equity line of credit, a overdraft protection, a credit card. However, the only exception is there's always a but, right? But you never want to be like maxed out on that card, right? So like bring the card balances a little under their limits so that we're not at risk of going over the limit, right? We want everything under the limit, period. So I guess over the limit cards should probably be up somewhere in there as well, but I hope no one, I don't, that's not really what I see a ton of.
And even though this is great priority that you're giving us, that's not always the formula, right?
Right.
So that's why.
I would say, ultimately, if you've got somebody that doesn't have delinquencies, right, and you have somebody with a debt problem, then I think that's a safe one to use, for sure. It's not going to change.
Excuse me, so this order is what really,
Somebody who has a revolving utilization that you're trying to positively impact the 30% of their credit score.
that's what we start working on. That's the order.
To influence that part of the score, that's how I would recommend you do that. Yeah. Yep. Okay. All right. So inquiries are part of new credit, the 10%. So I want to talk about inquiries for a minute. How are we doing on time? Because I'm going pretty deep in some of this.
We have.
Is this helpful, you guys? Is this working for you? Okay. I know, because we're all consumers too, right? Like this helps us, it helps our family. Yeah. Okay. So inquiries, everyone freaks out. Oh, I don't want a hard inquiry. Let me just see. I think this is actually my next slide. I can tell because it's pink. Okay. Hard inquiries versus soft inquiries. Hard inquiries mean you're applying for credit. It doesn't matter what type of application. It's a hard inquiry where it's going to post and it could impact your credit score if you apply for credit, period. A soft inquiry just means you're pulling your own credit for education purposes, right? Credit Karma, my FICO, and there's a couple new ones I'm going to introduce to you. Regardless, that's okay. It doesn't impact your credit score, okay? Now, if you're doing hard inquiries, the credit score, FICO in particular, dedupes inquiries to count them as one when they're grouped together. So in a mortgage situation, they dedupe them and count them as one if it's done within 30 days. So if Keith says, okay, Nicole, I need 20 points for this client, we do some little tweaking. I say, hey, Keith, go back and repull that. He can do that twice, I don't care, 5 times, as long as it's grouped together in 30 days, the FICO model counts it as one, okay? Auto, I believe, is 2 weeks. I think credit cards 2 weeks. So they're just grouped together differently, and it really does matter. So is it a 5-point impact for a hard inquiry or a 50-point impact for a hard inquiry? Well, we know it's 10%, right? We already know that, but 10% of what? It's not 10 points, it's 10% of something. I have to see the overall health of the credit report to be able to guess what I think that 10% equates to in points. Okay, if I have somebody with a really thin file that doesn't have a whole bunch of credit, that 10% could be 30 points. But if I have somebody with a really robust profile and they've got an 800 credit score, maybe a point, maybe 5 points, and then they're going to get that back, as it ages. Okay. Yeah.
So if a client was using a big bank or something like that, for some reason later on they decided, hey, we like your lender, so they might call Lisa and I, right, on things. And they ran their credit and it was over 30 days ago and we run it. Right?
Mm-hmm.
That's going to be that, and it's going to be a hard pull where it could possibly affect 10% of the score.
Yeah. And sometimes, so this is important. So yes, and sometimes that may be the right thing if you're trying to get a loan right away, but sometimes let's look at it before you even pull, and let's do a soft pull first. So I'm going to follow up with you guys, and I use my 2 preferred vendors as Identity IQ and MyScore IQ. They've given us codes where for $1, you can get a 7-day trial. You get all 3 credit bureaus and you get Vantage credit scores. Okay. That's Identity IQ. The ongoing monthly discounted rate for our clients is $19.99. So if any client that's going through any of our services, they have this turned on, it's a requirement, because how can I monitor and evaluate, create the baseline and then evaluate over time if I don't have a credit monitoring tool for all 3 credit bureaus, that I can gauge our increases, right? Now, I said something like this earlier. My score IQ, very similar, the $1 7-day trial, but it's $29.99. You get FICO general credit scores. If somebody is going for a mortgage, often we'll recommend My Score IQ because it's going to more closely align with the FICO mortgage model. And so we want to kind of track the more like scores before we have Keith, let's say, repull credit in that situation. So if they've already had a couple hard inquiries and or the client's like, they're just set on not having their credit pulled, totally fine. Just do a soft pull. It's not a big deal. Do a soft pull, they'll pay the $1, they'll get a 7-day trial, get it to us, let's work on it together. And then only when we know they're at the point that we need them at, then you can go do a hard pull, they get their loan approved, everyone's happy. So just because they're fixated on, oh, it's gonna drop my score 30 points for a hard pull because somebody told them that or they read that somewhere, fine, it's no big deal. Just do a soft pull. We can do the exact same credit evaluation, support them in the exact same way, and then we'll convince them when it's time to do the hard pull. Okay, so I will give you our discount links for those. Credit Karma is great, it's free, but you don't get Experian. Like, I don't know, if I'm fixing credit, I don't really want to just have 2 of my 3 credit bureaus fixed. I want them all fixed. So to me, I refuse Credit Karma. I also refuse annual credit reports. And that just doesn't give us a baseline of the scores. If you're saying I need a 680 score, I need a 100-point improvement, how am I supposed to measure that if I get 1 credit report at the beginning with no scores in it? Doesn't make any sense.
Can I explain about this? So we look at great scores, right? We take the middle one. If we only have 2 and you're only counting on 2, or our client's only counting on 2, and then we pull the third, and that one bureau counts collections a lot or something else on there that really affects their score. Now that score that you thought was going to be the middle isn't, it's the higher or whatever, and then and another one takes its place, and then all of a sudden our loan is different.
Okay, I want to talk about student loans. So sometimes student loan debt impacts debt to income ratio, right? You guys have it all the time. I mean, student loan debt is the second biggest debt for us as consumers. We do a lot of student loan modifications. If you're in default, we do rehabilitations. We also do assist with forgiveness. Just recently, our current administration changed the fulfillment process of getting forgiveness completed, which expires October of 2022. So we have a lot of clients now kind of rushing to get through that process. We are experts in student loans, just like we are in credit. The gal that does all my student loan work is out of Orange County. Her name's Tracy. She's just a whiz. So whether you need a lower monthly payment to improve the DTI, or let's say you're done with school, a best practice is if you've had multiple installments, whether it's you or your children or whoever the loans are for, you have multiple installment loans showing up on the credit report. You could have 20 because every time you take a draw while you're in school for the quarter semester, it actually opens up a whole new installment loan. So it's not unusual for us to see 20 installment loans from student loans. Do you think that the credit score is impacted by 20 loans versus 1? Absolutely, because it looks excessive. The credit score doesn't like an excessive of anything, right? Not excessive number of credit cards. Sometimes I tell you to close cards. Sometimes I tell you to open cards. Excessive number of student loans is not a good thing. And when they're consolidated, which is just a basic government program we're just doing processing for, it actually lowers the monthly fee and then reestablishes 36 more months of forbearance time. So clients are usually clueless on student loans. It's part of our free consultation. I will tell you 99% of our clients are like, oh my God, I had no idea. Thank you for explaining this to me. Even if they don't, go forward with one of our recommended services, they learn a ton through the consultation. So anyways, as student loans, come to me for help there. We talked a little bit about the analyzers. Okay, so how to refer. I don't care if you guys go through Movement Mortgage and come to me direct. I don't care, but I will tell you, if your client wants to buy a house, you're going to be doing them a much bigger service going through someone like Movement. I work with 300 loan officers. I'm a national company. I understand you may not always use Movement. I have worked there, my preferred vendor, and have been for many years. So I love working with them. But ultimately, a lending report and having them involved to tell us what middle credit score, what underwriting criteria is going to be the best for your client. If that's not their goal, fine, use the soft pull, or when you give them to me without a credit report, we'll use the soft pull for our preferred vendor. They're going to get the same level of service. It's not a big deal. You guys decide, but I will follow up with an email template on how to refer. You guys can customize that, but an email referral goes a long way, just like I'm sure it is for you guys. When somebody says, oh, I gave Joe your number, that's great, right? Ultimately, let's do a handshake. Let's, support each other. Let's do a referral with their contact details, introduce us, and then you'll get a response saying, thank you. You know that we've accepted it. And then it goes through our lovely automated technology, which is a big thing for us. And it helps us get them into the system and get them through our process flow. And you are copied. If you are the referral partner in the file, you're copied on major milestones. You'll see the proposal, what we're charging, what the time frame is, and then we'll get them back to you as soon as we can if buying a home is what they're looking for. So that's our commitment to you. My assistant's name is Alexis, and she's been with me for many years. So if you give me a file without a credit report, it'll go through her. She'll help gather the goals. She'll help determine if we need the student loan questionnaire filled out to assess student loan options. She'll pull the report, she'll prep it, get the call scheduled for me. Right now I'm doing 100% of the calls. And that's, just a pretty streamlined process. Once we've had that consultation, we give them a verbal proposal, we follow up in writing, they know what they've got to do, and if they're ready, they enroll.
And guys, with all your prospecting, a lot of you are out there making a lot of calls, running into people, and then you're referring them to Lisa and myself, and then we're running credit and something is not working with it, and we say, hey, this is a project. A lot of times, you don't want to sit and wait for this person's credit to fix by yourself because you guys want to go find a good sale. What we do is we end up sending it to Nicole. Nicole's great about keeping it in her database. Like she was just talking about Lisa's earlier, and she has a lot of mine as well. But she keeps track of the loan officer that did it, and then obviously we keep track that we have to lead from you that keep on going out there and shopping. And then when it's better, all of a sudden we're going to tell you, hey, this person came back, go call them again.
Mm-hmm.
Makes sense. So that'll save you time and let you keep being productive.
Yeah. Yeah, and I just for us, for our loan teams, if they're being shopped, I'll personally call them. The client tells us a lot. We're interacting a lot with them. And so they're like, oh, well, so-and-so said they think you can get the loan now. We don't even have to finish the full 6 months of services with you. And I'll personally call. And every time we send an update, we call them our credit repair progress reports. It says hey, I don't show you opened a credit card. Hey, your credit card balances are too high, right? We're doing our coaching on the 65%. It's a great time to re-engage, whether it's the loan team, you guys, it's hey, it looks like your scores came up 40 points. That's awesome, congrats. I noticed Nicole said you got a new collection, or I noticed Nicole said you didn't do X, Y, Z. Those are great times just to re-engage, kind of just remind them how important it is, do their homework, keep them committed. And so for some of our, I've worked with Amanda, I don't know if you guys know Amanda Silver at Movement Mortgage and in the San Diego office. I did a presentation yesterday for them. I mean, she's got a lot of staff under her. She's pretty big loan officer over there, but I'm telling you, she's got staff that every email they send, they're following up with that client. They CC us on it. I mean, I see it, I see the activity. And I think it really does make sure that when that client is done with us, that they get that loan and they're committed to making sure, hey, I referred him to Nicole. I'm going to darn well make sure I get that loan at the end, right? And so it's up to you guys to how much you want to foster that relationship. It should be super low maintenance. I mean, we're managing the pipeline for the files you send us, but it's also important just to remind them that you're there and just, hey, congrats, good job, whatever. Just, you're on that email for a reason. It's an opportunity for you to re-engage and stay engaged. And that seems to work really well for a lot of our partners who do it that way. I am going to send this to you. I do want to show you, there's a couple slides I recently added, and I added these for the realtors. These are questions and answers on what you may be getting from clients and how to answer them. And I just thought one of the things that I think is so confusing, and some of it, I'm happy to add, if for example, this one, when I give you guys a credit clarity guide, send it out in your email campaign, send it to your clients, anyone that you've talked to that said, hey, I know you said you had some credit challenges. We have this partner that we use, and I saw this new material she sent. I thought it was really valuable. Send it to them, right? So use our material. It's, I'm giving it to you as well. It's educational. And I can tell you credit, I love it. As you can see, I'm a total credit geek, but people just don't understand it. There's so much misinformation. And so spread the word, use the tools, use them as you wish. And I'm here to support you guys to help you be successful. And again, I thank you for helping me be successful as well.
A last question that came in, does net worth play a factor?
Not in credit. Nope. In any of the profile data, and I can even pull up a credit report. Oh, my battery's low. I may not be able to. Any of the profile data, which is your personal information, name, addresses, date of birth, employment history, none of that is used in credit scoring in any way. It's illegal. It became illegal many years ago. So it's truly just the trade line level data that, goes into that pie chart.
So the objection handling that you have for the credit, is that, you're gonna send it to our email that we filled out on that?
Yeah. So Keith's been kind of creating that. We might even send it to the whole list, but yeah, you guys will get this, and then you'll get the credit clarity guide. Fraud. This is another one. If you have anyone that's been a victim of fraud, I spent a lot of years in fraud, both identity and transactional fraud. So there's a big fraud process that we guide clients through and support with as well. And remember, when it comes to fraud, that personal information, a lot of times you'll have addresses and information on there that's not associated with the true person. It's super important to clean that up. So we'll help walk through the police report, the fraud affidavit, and everything that has to go into claiming something's fraud. Yeah, that's it, I think. Yes.
One question.
Okay.
To be clear about that. You said something about they combine the applications within 30 years, 30 days, sorry. Does that mean that if someone starts, let's say, applying for some kind of loan today, and they apply to different companies within 30 days, it's gonna be count all as one? Is that
For a mortgage application type, that is correct. So you're talking to, just for the people on the phone, deduping number of inquiries within 30 days. Yes, that's a true statement. It
that
counts.
30 days starts when they start applying, or first of March for the last?
It's just in calendar days. Yeah. And one more thing I often get asked is, so when does my credit bureau, like my credit card, when does that get updated to my credit report? So let's say your payment on my Bank of America credit card, it's due on the 15th of each month. I just happen to have a 2-day grace period, and then I have a statement date on the 17th. The statement date is when my next statement cuts. That's when my interest gets charged if I have a balance, right, that I'm rolling over from the previous month. And that's also when my data gets captured and sent to my credit reports. And then the 3 bureaus take their leisurely time to update it. Usually within 7 days, all that data is updated. So if you're trying to figure out, like, somebody who's like paying down credit card balances, they'll come to me and go, well, when is it going to update? I paid it last week. Okay, well, I don't have an answer. You got to look at your credit card statement. When does it cut? Count out, like an extra 7 days. So it varies by account type based on your due date and your statement/cycle date. And then you got to give the bureaus time to update. Okay.
How much does this whole credit repair cost?
Yeah, it's a great question. So our pricing for services, we have about 12 services, start around $200, and they go up to about $1,000 depending on. Most credit repair is like around $105 a month. We are revamping our pricing as we bring in more education and more tools. The pricing is going to look differently starting in 2022. So I don't know exactly. I'm working on it, but it is going up. Yeah, we provide a lot of value, and it's time to kind of monetize that a little bit more. But I can tell you we're way underpriced, and especially for the value we provide.
I had a guy come up to me the other day and said that was a credit repair company. And he says, yeah, I charge them like just $500. That's it. So she's already starting $300 less.
Yeah, sometimes it's like a federal escalation. If I have documentation to show something's misreporting, I do a federal escalation, $200. It's usually fixed within 2 to 3 weeks. So it's just, you have to customize the right solution for the problem depending on so many different variables. So. All right. Well, thank you guys so much. I appreciate you.
Lisa and I, we got some lunch. So there's some Jersey Mike's if you guys want. So feel free to grab a sandwich.
Thanks everyone on the phone. We'll follow up with an email.
Yep.
Take
Did
care.
everybody, sign in. That's here today. Okay, great. So make sure you guys get the slides and then contact info.